In this video, I will walk you step by step through a complete master budget for Handtoys. We will go from sales all the way to the budgeted income statement and balance sheet. And along the way, I will explain why each schedule exists and how everything connects. By the end of this video, you will be able to understand how a master budget flows logically, not just mechanically. See how inventory and working capital policies affect cash and borrowing, and avoid the most common exam traps, especially around the COGS and cash budgets. Before we build anything, we need to understand the assumptions. Handtoys sells fidget spinners for $20 each, all on credit. Cash is collected 40% in the month of sale, 50% the next month, and 10% the month after. Finished goods inventory must equal 60% of next month's sales, and the raw materials inventory must equal 30% of next month's production needs. These policies are what create timing differences, and those timing differences are the reason budgeting exists. The sales budget is always the starting point of the master budget. For Q2, sales are April is 20,800 units, May is 30,500 units, and June is 40,900 units, and $20 per unit. Total Q2 sales revenue is $1,844,000. Everything else in the master budget is driven by these numbers. Sales do not equal production because the company carries inventory. The formula is production is sales plus desired ending inventory minus beginning inventory. Ending inventory is 60% of next month's sales, which forces production to increase before peak sales month. For example, April production is 26,620 units, even though April sales are only 20,800. Each unit requires 2 kg of plastic, purchased at $1 per kilogram. We first calculate materials needed for production, then add desired ending raw materials and subtract beginning raw materials. This gives us materials to be purchased, not materials used. Over Q2, Handtoys purchases 188,047 kg of plastic, costing $188,047. Each unit takes 15 minutes or 0.25 hours to produce. Workers earn $15 per hour, and overtime is not allowed. Labor hours are driven entirely by production, not sales. Total direct labor cost for Q2 is $367,575. Manufacturing overhead has a variable component of $4 per unit produced, a fixed component of $25,000 per month. Important detail: fixed overhead, manufacturing overhead, includes $5,000 of amortization, which is non-cash. For cost and inventory purposes, we include amortization. For cash budgets, we exclude it. This is where many students make mistakes. COGS is not sales multiplied by unit cost when inventory changes. The correct formula is COGS is beginning finished goods plus COGM minus ending finished goods. Because Handtoys carries inventory, some goods sold were produced last month, and some remain unsold. Total COGS for Q2 is $954,744. Selling and administrative costs include variable shipping costs of $2.25 per unit sold. Fixed monthly costs such as salaries, utilities, insurance, and Miscellaneous expenses. Total S&A expenses for Q2 are $474,450. Note that insurance is prepared, which matters later in the cash budget. Because all sales are on credit, cash receipts lag behind sales. For example, April cash collections come from 10% of February sales, 50% of March sales, 40% of April sales. Total cash collected during Q2 is $1,499,800. Materials are paid 50% in the month of purchase and 50% of the following month. We also include accounts payable from March 31st. Total cash paid for materials during Q2 is $180,237. The cash budget brings everything together. Handtoys requires a minimum ending cash balance of $20,000. When cash falls below this level, the company borrows at 12% annual interest in increments of $1,000. Even though the company is profitable, it still needs to borrow due to timing differences. Ending loan balance at June 30th is $33,000. From the operating budgets, we prepare the budgeted income statement. Sales is $1,844,000. COGS is $954,744. Gross profit is $889,256. Net income is $412,000 and $326. Profitability does not equal liquidity. This is the key takeaway. The balance sheet reflects ending cash from the cash budget, accounts receivable from uncollected sales, inventory balances from the inventory schedules, fixed assets net of accumulated amortization, outstanding bank loans and retained earnings. Total assets equal $1,002,685, matching liabilities and equity. So, three big lessons from this case. Inventory policies drive production and cash needs. COGS depends on inventory movement, not just sales. Cash flow timing can force borrowing even when profits are strong. This is exactly what master budgeting is designed to reveal. On exams or in practice, always ask what assumptions drive cash the most? What happens if collections slow down? What if inventory policies change? Master budgets are not about math, they are about understanding business dynamics. If this video helped you understand better, please hit the subscribe button.